Hello, Andrew Myams here from Intuitive Finance. Thanks for listening and viewing. I thought I'd have a chat to you about cash flows, and that seems to be in the news a lot of recent times in respect to rising interest rates. Now, for what it's worth, I'm not sure that we're going to see any Reserve Bank rate rises anytime soon. However, we still have, over the last 12 to 18 months, all experienced as property investors some rising interest rates. So what do we do about this, and how can I protect my cash flow? There's a number of great strategies. So the first thing people always tend to shop for is rate. What's the best rate you can get me? It's not always rate that's the most important, especially as a property investor and someone trying to build a portfolio. What's more important in those circumstances is your cash flow, your ability to manage your finances and to have the ability in ups and downs, and when tenants might move in and out of your properties and you haven't got any cash flow for a month or so, that's when the key is. So that's not a rate discussion, that's a cash flow discussion. Now sure, one of the best ways of doing that is interest only, and only paying the interest each month on your loan, where there'll be no capital reductions. Now, I don't think you should be doing that for your home. If you can't afford to get into your home, I think you need to change your budget and have a lesser home loan. But as an investor, it makes sense, especially if you have what we call non-deductible debt, being your home loan or personal loans or credit cards. You should make an effort to get rid of those first. So interest only makes sense. You might pay a bit of a premium now in the current market because that's what the regulators and the banks have been trying to do to slow down our markets. You'll normally pay between 0.5% and 1% more than what you will for a principal and interest loan, but it will still be cheaper for you to hold from a cash flow perspective. The second thing is if your cash flow does allow it, paying principal and interest. Paying principal and interest will often only mean a difference of between maybe $300 to $500 a month on, say, the average $500,000 loan. You'll get a cheaper interest rate, and for those starting out, we're advocates of people paying principal and interest off their loan because it'll generally allow them to secure a better asset earlier on because it increases your borrowing capacity, as well as getting that equity into the property. Now, everyone seems to think, no, if I pay the principal off, I can't use the equity again. That's a misnomer. Of course you can. We often encourage our clients to do a review and look at your position, get a new bank valuation, and if there's equity there, we can use it. But paying principal and interest as you're starting out is a great strategy in the current market to get you, one, started in the market, and two, build that equity. We never know what a property might do. We know the averages. We know property tends to perform in different cycles. The one thing you can control, if you can afford it, is your principal reductions. Let's build some equity and look to the next property. The next thing you can and should do is always make sure you've got an adequate buffer. And an adequate buffer means that you should have, like a business where a lot of businesses have overdrafts, you're effectively in your property investing should have an overdraft there. You should have a buffer. You should have some funds that are there for a rainy day that will help you should anything goes wrong with your property or your property portfolio. What I mean by that is generally you get new tenants in your property and of course the hot water service blows up. Now if you're running things very fine to the bone, you need to replace that hot water service, otherwise the tenants aren't going to be very happy with you. That's what a buffer's for. It's also for the difference between managing your cash flow during the year, where you might have a difference in the rent you earn and the payments you need to make. The buffer is there for that. At the end of the year, you might have a negative gearing allowance and you might get a tax refund. Then you can top up your buffer or pay down some other debt. But that's what a buffer is for. It's there to protect you in all the times. Property investing isn't about the style of property you buy. Well, actually it is, because if you buy bad properties in bad areas, it won't perform. But property investing is about the long term. It's time that makes you money. Time in the market is what will make you money. And the final thing you can do to assist your cash flow is review your finances regularly. It's one thing that Australians don't do that often. We are a complacent mob. As long as the sun's shining and there's a beer in our hand, often we're quite comfortable. Happy to have a go at all the banks, but we don't take action to review our positions. That's one of the best ways you can improve your cash flow. You might not know what offers are out there, but we do. So there would be 4 great tips I think you can utilize to help your cash flow positions, getting yourself into a better position from a buffer perspective, and making sure you're doing a review regularly just to check that everything's on track and going well. I hope that helps. If there's anything we can do to help, of course, I'd love to hear from you here at Intuitive Finance. Until next time, see you soon.